Yeah, hello guys. Welcome once more to CryptoZilla channel. Today I'll be showing you a unique feature on Binance that can actually help you to minimize your risk and maximize your profit. So far you follow the rules. It is nothing else but hedge mode. There's a feature called hedge mode on Binance that can actually help you to open both long and short positions while trading futures. Now let's look at what Binance said about hedge mode and see what it really means, what hedge mode really means. Now, if you go to, let's open, okay, here you said this update was made in 2020. It said Binance is excited to announce that we have released hedge mode on Binance futures. In hedge mode, users can hold positions in both long and short direction at the same time under the same contract. Users will now be allowed to switch between one-way mode and hedge mode in preference setting. Now, on one-way mode, which you are all conversant with, what happens on one-way mode is that once you open a position, then open a counter position on it, like let's say you long, then you short at the same time on a one-way mode, the short will cancel the long. So that is what happens on a one-way mode. But on a hedge mode like this, if you look, it's looking quite different from what you have on your own, which is a one-way mode. You see, this is different from what you have. So if you want to really go into the hedge mode, what you need to do is to go to these three dots up here. You click on it. You go to preference here and go to position mode settings. Click on it. Then you see you have one-way mode and hedge mode. It's written here, one-way mode, a symbol only supports holding a position in one direction, while in hedge mode, a symbol supports simultaneously holding long position and short position, and unrealized profit can be offset between two positions of the symbol. You see? So it will actually allow you to open two positions on one contract. So that is what the hedge mode actually means. Now, if you watch here closely, I had to open this position for the sake of this tutorial, just for this course, to teach you what I mean by that hedge mode and how it is being done. Now, I opened this randomly. I didn't really do any analysis before opening this. I just want to use to teach. So lucky enough, it's already in profit. But now I want to open a counter position. That is a short or a long position rather. This is a short position. I want to open a long position as against this. So you see what I mean by that. Now, I wouldn't want to go into the chart to really do any analysis. Let's say here I entered with 2.26 as the margin. Let me use the same 2.26 as the margin here to open a long position. Let me use 2.26. Okay, this is 2.28. Let me use that to open a long position. Most times I like placing a pending order. Since we're having 430 something here, let me use 430. Oh, it's already far beyond that. Let me use 420 rather and see what happens. Okay, I know we are in loss, but let's see what is going on there. Okay, this is the last position I opened on long. This is the short. Now, what happens here is this. If you look, they are having the same leverage, 40x, 40x. The liquidation here is, liquidation price is 318. Here, liquidation price is 318 as well. So, liquidation price 318.02, here 318.02 as well. So it will actually take so long for these markets, these orders to get liquidated. It can run for days. Before the price of ZIL will actually get to 318, it will really take a year plus or thereabout. Now you see the essence of hedge mode. So it will help to boost up your liquidation price, keep you at profit. If you watch, the two of them are now in profit. So they are both in profit. Now, if you watch the entry zones, the entry price and this entry price are the same. This mark price and this mark price is the current market price. Why the margin here is quite bigger than this margin. Now, how do you calculate your profit here? Now, on calculation of this profit, you have to minus your entry price from the mark price, then multiply it by your size. You know your profit. You minus this from this, multiply by this size, that will get you your profit. The same thing applies here. You minus your entry from here, multiply by this, you will actually get what the value is right there. Why the percentage here actually has a direct effect on the margin which you entered. 4% of this is this. So it is two-way thing. The price that reflects here actually works with two features. It has the effect of this leverage and as well what is going on with the size and the entry price minus from the mark price. Now, I also did a video where I talked about risk reward ratio, where you can actually know what happens to why you tend to have more profit if you have a high leverage, and you tend to have more loss if you use a high leverage and the market is against you. I made a video on that. If you check this channel, there's a video on that. So you can actually get to know your risk reward ratio, how it's being calculated, how to set your stop loss, where to set your stop loss so it doesn't get triggered easily once the market goes a little bit against your prediction. Now, if you watch here, the margin is 2.4 here, here is 2.6. Their mark price, they are always the same. That is the market price. Now, on this hedge mode, this market will remain this way for a very long time. I might come here tomorrow, I will get $10 here or thereabout. But remember, I didn't do any analysis before entering this. I just had to queue into the market blindly so as just for to carry out these tutorials. Now, there's something I need to tell you about trading with this kind of pattern. Now, first and foremost, you must get to know the trend in which this market is. If the market is on a bearish trend, that means you are at high chances of making more profit if you're on a short. Where the long positions will always come in is when you notice there's a pullback or a retracement about to happen. You enter your long, you exit your position, or you take profit where it's necessary while your short position actually continues. Now, unlike here, on this case, let's look at the chart. Binance has been misbehaving for days now. Now, if you look at the chart, it seems as if the market is about kind of changing direction. There's a gradual change of direction in this market. It's gradually exhausting its sales pressure or sales strength here. So it's trying to regain its track back to become a bullish market. That is why you see the long position there taking charge. But before now, yesterday and day before yesterday, in fact, for the few weeks we've known, past few weeks, we've known that the market has been on a major downtrend. So within this range here, when the market was on a downtrend, you have more chances of actually making more profit when when you enter a short trade. You have more chances of making a greater profit. But remember, within this downfall here or within this bearish market, there are retracements happening within the candles where the market will actually push back upwards to clear some liquidity upwards and as well come back to maintain its downtrend. Now, at that moment where it goes back up, let me go to 1 hour candle and show you. Now, let's see here, at this point here, you notice that the market got to this point here and had to trace back upwards. Now, let's assume I was in a short market from this point down here, and I notice the market is about retracing a little bit upwards. What I need to do is to enter long. I collect my profit at the top, and while the short trade is still going up, since my hedge mode can actually allow me to trade both ways, so I'm actually gaining from the short and as well the long positions. That is what I actually wanted to show you guys. Now, let's look at the effects of those margins on our liquidation price. Now, let me do a practical example Let's see what happens to this liquidation price if I reduce the margin. Now let me reduce this. Now notice this is 318.02. This is 318.02. Now let me reduce my short position here. Let me close it by, let me say, 25%. Let me close by 25%. You see what happened? So my liquidation price actually went back to 0.05795. Here, 0.05795. You see that the margin actually affects the liquidation price as well. Now, this is the size of the market, the number of positions I'm holding in the market. Remember, for those of you who are newbies to this, the margin is actually your capital that you use in buying this position, this huge position. The entering price will always remain that position in which you queued in into the market. The mark price is the current market price. So this is the two ways you can actually use your buy and sell positions at the same time on Binance. Now, if you watch here, let's assume I enter this position alone. I didn't enter this. I would be on minus 14 or 13 USDT or 13 cents or thereabout loss at this point. But since I have a position here, I'm in profit. If I minus this from here, I'm already in profit. So it's a two-way thing. You see that one is on a loss or one is on a profit. That will help to actually balance you up. But you need to be careful to know your risk exposure here. If your risk here is very high at this point, here is a little bit low, here is high, but it can hold since the liquidation price is very far from the market price, which we have now. Before this market will get to this point, this would have made a very lot, this would have made a lot of profit to balance up the effect of this one. Now, at that point, you still get liquidated if you do not still have much fun to boost it up, because the margin between this and this is huge. If you remember, the entering price here is not the same with the entering price here. So since I'm shorting here, the more the market goes down, I'll make more profit. Now, let me show you something. Let's do let me show you a practical example of what I'm trying to explain to you. Now, look, since they say we are going to liquidate at 0.0579, let me do that. Let's see what it happens. Positions 0.0579. I'll be making 15 USDT profit if it gets to that point. Now, let's go back. So if the price actually gets here, I'll be making 15 USDT here. Remember, they're having the same liquidation. Let's check on this one as well. Profit 0.059. You see, I'll be making 19 USDT loss here. I'll be losing 19 USDT. So definitely, it will liquidate that account because I'm not having much fun here. What I have here is 3 USDT. So if you have that 3.57, add it to the 15 we got from this one, it will automatically amount to the 19 we had here. So you see that this one here will balance up here, the one down here. Let me show you again. Now let's assume we want to close this position at 0.05795. 0.05795, 15.18. Let's close this one at that price and see. 0.05795. Okay, 21 USDT. Okay, this one should be correct. I was wrong the other time. This is 21 USDT. That means if it gets to this liquidation price, here I'll be having minus 21 USDT. Here I'll be having minus 15 USDT. Now, why then would the two of them liquidate at the same point? The reason is that since I'll be making more loss here, the profit I'll be making here is lower, 15 here, 21 here. Now 15 plus 3.52 here added up to what's this 2.4 here will amount to $21. So it actually balances. I'll be making 21, I'll be losing 21. The market will cancel itself, the two of them, and I'll be out of the market. I've got liquidated automatically. So don't think if you open a short and long position, you will not get liquidated. No, it's just for that time, for the time being, for some time, to actually hold your position, to wait for a major breakout. You can gradually close the one that is against you and maintain your profit on the one that is in your, that is actually going in your favor. So it's not to be left for a very long time, because if you leave for a very long time, definitely it will actually, if it wants to go against you, it will actually hit the liquidation price and get you off the market, liquidate all the assets you have and still put you off the market. So don't think hedge mode is always is risk free. No, it's not risk free. Like I said, it will just help to manage your portfolio at the meantime while you wait for a breakout to actually close that which is in your which are against you, or you use hedge mode to actually scalp profit. Let's assume you're on a downtrend, you have a position in a downtrend already, and market is on a bearish trend. But at intervals, you want to take advantage of the retracements. You can open long positions, you make your little profit while your short position is still being maintained. So at that moment, you are making profit from both sides, both from the trend and also the retracement. The same thing, if the market is on a bull trend, is on an uptrend, at the intervals, there should be a retracement. You can open short positions to take advantage of the retracements, make a little profit while your long position is being still maintained. So that is the essence of uh, hedge mode. So it's a straightforward thing. It's not hard. It's very easy. But you must make good calculations. You must understand what you are going into before you actually attempt doing this. So I would advise you to practice this on your own. Make use of low margins. The one I is teaching you now, $2 and all that. You can make use of low margins to actually see what is going on how the hedge mode actually works. So this is the end of these tutorials. Intervals, I will be making more videos to teach you and show you how to navigate or have your way around this around the Binance interface, and also be teaching you some strategies in which you use to trade and make profit and minimize your losses. So this is CryptoZilla. I'll plead with you to subscribe to this channel, and as well click on the notification bell so you get notified whenever I drop new videos on trading. Thank you and remain blessed.